Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the financial jargon so you don't have to. Today we're diving deep into Pioneer Bancorp Incorporated's latest quarterly report. Think of it as peeking behind the curtain at a bank's financial health. So what is the big story here? Well, Pioneer Bancorp Incorporated, or PBFs as you might see it on the stock market, just dropped their Q3 report for 2025. It's like a financial checkup, and we are going to decode what these numbers really mean for the bank and for us as potential investors or just curious observers. Make sure you are subscribed because we break down these kinds of documents regularly. And if you want to chat about this stuff and get more real-time insights, join our Discord community linked in the description below. Let's kick things off by looking at their balance sheet, or as they call it here, the consolidated statements of condition. This is like a snapshot of everything the company owns and owes on a specific day. On the 30th of September 2025, Pioneer Bancorp had total assets of about $2.24 billion. That is a solid amount of money and stuff they control. Now compare that to the 31st of December 2024, when it was closer to $1.98 billion. So the bank has grown a good bit, about 13%. What is driving this growth? A big piece is their loans, which jumped by nearly $180 million. That is how banks mostly make money, you see. But what is also interesting is their cash and cash equivalents nearly doubled, reaching over $228 million. Growing loans is good, but having a lot of cash on hand can mean a few things. Maybe they are preparing for more growth, or maybe they are being cautious. Digging into those loans, the net loans receivable reached over $1.6 billion. That's a pretty significant increase from last year. It shows they are actively lending money, which is their core business. Residential mortgages saw a substantial jump, adding about $74 million commercial real estate loans. Construction loans and commercial industrial loans also grew nicely. This all paints a picture of a bank actively pursuing business across different sectors. Now let's flip over to the other side of the balance sheet, their liabilities and shareholders' equity. The biggest chunk here is deposits, which they have nearly $1.9 billion of. That is up about $300 million from the end of 2024. This growth is fueled by people and businesses trusting them with their money. Notice how they're non-interest bearing deposits. The kind that don't pay interest like checking accounts grew significantly. This is often a good sign for a bank, suggesting some customers prefer the convenience of these accounts. Shareholders' equity, which is basically what is left over for the owners after all debts are paid, is around $314 million. This also saw a healthy increase, mainly due to the bank's profits and an increase in what they call accumulated other comprehensive income. So things are looking financially sound from this snapshot. Alright, moving on to the income statement or the consolidated statements of operations. This tells us how much money they made and spent over a period. For the third quarter of 2025, Pioneer Bancorp reported net income of about $4.3 million. That is down from about $6.3 million in the same quarter last year. Why the dip? Well, let's break it down. Their net interest income. The difference between what they earn on loans and investments and what they pay on deposits and borrowings did go up. For the quarter, it reached over $20 million, up from about $17.9 million last year. This is a positive sign, showing they are effectively managing the spread between what they earn and pay. The report mentions this increase was driven by a higher average yield on their interest, earning assets, which means they are making more on the money they lend out. A good thing generally. However, the provision for credit losses, which is like setting aside money for loans that might not get paid back, jumped significantly. For the quarter, it was $785,000 compared to a credit of $870,000 last year. This means they are expecting more potential loan losses this year, or at least accounting for it more conservatively. Non-performing assets. The loans that are already in trouble also went up, representing about 0.5% of their total assets. This is a key area to watch. Their non-interest income, which comes from things like fees for services, insurance, and wealth management, actually went down slightly for the quarter. It was about $3.8 million this year compared to $4.1 million last year. So, while their core lending operations are bringing in more, other income sources are a bit weaker. And then there is non-interest expense, essentially their operating costs. This is where we see a significant jump. For the quarter, it rose to $17.6 million from $14.7 million last year. That is a 20% increase. The report points to higher salaries and employee benefits, which is common with growth, but also a notable increase in other expenses of $2 million. This jump in other expenses is a big red flag, and the report hints it is largely due to litigation. Related expenses, we'll definitely dig into that later because legal battles can be very costly. All these moving parts combined to reduce their net income for the quarter. So even though they brought in more from loans, higher expected loan losses and noticeably higher operating costs, especially legal fees, ate into their profits. Now let's look at the statement of changes in shareholders' equity. This shows us how the equity part of the balance sheet has changed from the beginning of the year. It breaks down the profits, other comprehensive income, which includes things like unrealized gains or losses on investments, and share repurchases for the 9 months ending September 2025. Net income was about $16.5 million. This is up from about $15 million in the same period last year. So over the longer 9-month stretch, the bank has actually improved its profitability, which is great to see. The increase in net income was driven by that stronger net interest income we talked about. There is a section talking about their employee stock ownership plan, or ESOP. This is how they give employees a stake in the company. It's good to see employee ownership, but we see how ESOP shares affect equity calculations. This section is really important. It's about things that could cost the company money down the line but aren't on the balance sheet yet. Think of it as potential future liabilities. They talk about commitments to extend credit, which are promises to lend money totaling over $357 million. They also have standby letters of credit, like guarantees for customers, worth about $27 million. Then there is the big one. Legal proceedings. This filing mentions significant ongoing legal battles, particularly related to something called man entities fraudulent activity. It appears the bank might have been involved in some problematic transactions. They are facing claims for millions of dollars, and they've acknowledged that adverse outcomes could have a material impact on their business. They've incurred significant legal fees and expenses related to these matters, and the report states they expect these costs to continue. This is a major risk for the company. They are fighting these claims vigorously, but the uncertainty and potential financial exposure are considerable. Looking further into these legal issues, there is a lengthy explanation of lawsuits filed by various parties like Southwestern Payroll Services Incorporated and National Payment Corporation. These complaints involve complex allegations including fraud, conversion, and violations of RICO, the Racketeer Influenced and Corrupt Organizations Act. The claim damages sought are substantial in the tens of millions of dollars. The banks have filed counterclaims, basically saying the other parties owe them money too. This is a protracted legal battle with trials as far out as August 2026. Let's touch on fair value. This is how they determine the worth of certain assets and liabilities. They talk about level 1, 2, and 3 inputs. Think of level 1 as easy to find public prices. Like for stocks, level 2 uses related observable data, and level 3 uses unobservable data, which requires more judgment. Most of their securities are level 2, meaning their value is based on observable market data. However, loans that are individually evaluated and some other real estate that they own are valued using level 3 inputs, meaning more assumptions and judgment are involved. This is important because it implies a higher degree of subjectivity in valuing those assets. Let's talk about the overall health and direction of P.I.O.N.E.E.R Bancorp. On the positive side, they are growing their loan portfolio and their deposit base is expanding. This suggests they are attracting customers and actively participating in their core banking business. Their net interest income has also improved, showing they are making more money on their lending activities in the current interest rate environment. However, there are definitely some areas of concern. The increase in the provision for credit losses and the rise in non-performing assets suggest potential trouble down the road with loan repayment. More significantly, the substantial increase in non-interest expenses, largely driven by ongoing and complex legal battles, is a major risk. These legal proceedings could lead to significant financial penalties and operational disruptions. While their equity has grown, the uncertainty from these legal issues could overshadow much of the positive operational performance. For a bank operating in today's environment, managing loan quality and navigating regulatory and legal landscapes are paramount. P.I.O.N.E.E.R Bancorp is showing signs of solid operational growth, but the legal entanglements are a dark cloud that could significantly impact their future. Investors should watch these legal developments very closely. Alright, that is our deep dive into P.I.O.N.E.E.R Bancorp Incorporated's latest report. What do you think about their financial health and those legal entanglements? Does it give you pause or do you see opportunity? Let us know in the comments below. If you found this breakdown valuable, please give us a thumbs up and subscribe for more corporate decoding. And remember to hop into our Discord community linked below to keep the conversation going. Thanks for watching, and we will see you in the next video.